Welcome back to another episode of 2 Minute Tuesdays. I am here with co-founder Jack Martin from 5210. And today we're going to talk about internal rate of return and why IRR might not be the best metric to look at when you are looking at investment opportunities. So Jack, I'd love to get your thoughts on the metric of IRR.
Yeah, so let's unpack this a little bit. IRR, first of all, essentially says this is the return you'd get if you exit the deal. Usually IRR to us is more of an optical thing, so it allows us and our LPs to compare deal versus deal. Typically, when there's a higher IRR projected on one of our deals, it's because there's greater degree of risk, more reward. So that's going to come in the form of, more vacancy and more heavy lifting typically equates to a higher IRR. And a more stable asset that's just operational upside is going to be a kind of a mid-teen or lower mid-teen IRR. One of the things that I think investors miss is that the way to get a really high IRR, call it a 30% return, is to do the deal really fast. So get in, reposition, and get out in 24 months.
When I'm talking with investors, they're generally asking about IRR because that's what they're seeing advertised by other operators. And the discussion we have is that as you hold an asset longer, it's more difficult to maintain a higher IRR because of the length of the hold. Strictly, the measurement of IRR is very specifically time value of money and how quickly you're getting your money back. And if our goal is to hold on to that capital longer to provide long-term cash flow benefits to our investors, then our IRR is just organically going to be lower than it would be if we were flipping a deal real quickly in 3 to 5 years.
I would come back to you and say it's not strictly time value of money. Yes, that has the greatest amount of impact, but also we're buying properties that have room to add value. So we're going to go improve the performance of the property. Usually that takes place right away in the very beginning of the first couple of years, which when you get it stabilized, you can return some capital, right? But then the NOI growth of the property tends to kind of stable or flatten out. And so you're not getting this massive gain in NOI versus the value of the property. And since you're never exiting the asset, you can't truly come to an IRR outcome.
That makes sense. Yeah, the riskiest portion of that business plan occurs in the acquisition and in the first few years when you're stabilizing and increasing the NOI.
Yeah, so if you can go through that period of early risk, extract value, which really comes in the form of a refinance, get all or the bulk of your capital back in your pocket, and you keep the coupon, now you're kind of owning commercial real estate risk-free. That's what it comes out to.
Great topics, great conversation about IRR. Thank you for sharing. Let's go ahead and wrap up this 2 Minute Tuesday, and we will come back again next week with another great topic with another great member from 5210. Thank you.